Washington's response to this trillion-dollar threat has been remarkably quiet and concerning. Treasury Secretary Scott Bessent flew to Tokyo multiple times throughout 2025 negotiating deals. Commerce Secretary Howard Lutnick joined those talks, trying to calm Japanese officials down. The administration paused most global tariffs specifically to get Japan back to tables. Japan was one of Washington's first diplomatic priorities after April 2025 tariff chaos. But progress stalled quickly over American tariffs hitting Japan's critical automotive export sector. Toyota, Honda, Nissan faced 24% reciprocal tariffs, crushing their U.S. margins. Japanese automakers employ hundreds of thousands of American workers across southern manufacturing states. That tariff wall now threatens American jobs while angering Japan's most powerful industry. Meanwhile, the Bank of Japan faces its own domestic nightmare nobody talks about. Japan's national debt ratio sits near 260% of GDP currently. That ratio is the highest among any developed industrial economy on Earth today. Rising domestic yields make servicing Japan's own debt exponentially more expensive yearly. Every basis point higher in Tokyo costs Japanese taxpayers hundreds of billions annually. The Bank of Japan is now trapped between inflation, weak yen, rising yields. Prime Minister Takaichi's stimulus packages pour fuel directly on this raging fiscal fire. Japanese 40-year bonds hit record yields partly because nobody trusts fiscal discipline. When your largest creditor is fighting its own debt crisis, America has problems. Bloomberg reported 2 of America's biggest debt holders are actively dumping treasuries. That headline ran in November 2024, and the selling has only accelerated. Foreign official institutions sold $46 billion long-term U.S. securities February 2026. That single month of official sector selling was among the largest ever recorded. Foreign private investors tried offsetting those sales by buying $147 billion. But here's the catch every American investor needs to fully understand today. Private foreign buyers demand higher yields, meaning higher interest rates across the board. Official buyers like Japan's central bank were price-insensitive buyers, absorbing trillions quietly. Replacing them with yield-hungry private buyers means permanently higher borrowing costs forever. Morgan Stanley and Goldman Sachs analysts have modeled these exact yield implications. Their projections show 10-year Treasury yields potentially breaking through 5.5%. At that level, American home sales could collapse by 30% nationally. Small business lending would freeze because no bank extends credit affordably anymore. Corporate bond issuance would stall, triggering layoffs across tech, retail, and manufacturing. The S&P 500 faces price-to-earnings multiple compression that traders dread most. Wall Street has a technical term for this entire scenario: bond vigilantes returning. Bond vigilantes are global investors who force fiscal discipline by dumping government debt. They broke Bill Clinton's spending plans in 1994, sending yields above 8%. Clinton's advisor James Carville famously said he wanted to reincarnate as bond market. 30 years later, those vigilantes are circling Washington again, this time from Tokyo. The warning signs are already flashing red across every single major market indicator. Gold hit $5,000 per ounce as investors flee paper currency assets. Silver punched through $100, completing a generational threefold rally quickly. Bitcoin surged past record highs as younger investors seek alternatives to treasuries. Central banks globally bought over 1,000 metric tons of gold last year. That rate of official gold accumulation has not occurred since the Cold War era. Russia already dumped its entire American treasury position years ago, buying gold instead. China reduced its holdings by roughly 33% over just 5 short years. China now holds $693 billion, down from over $1.1 trillion. If Japan follows the same trajectory, American financial architecture faces severe structural strain. The dollar's reserve currency status depends entirely on foreign appetite for American debt. Roughly 58% of global central bank reserves sit in American dollars still. That share has fallen steadily from over 70% just 20 years earlier. Every year, the dollar loses ground to euros, yuan, gold, and digital alternatives. A sudden Japanese exit could accelerate dollar decline by 5 to 10 years. For everyday Americans, dollar weakness means imported goods cost significantly more money. Gasoline, electronics, clothing, pharmaceuticals, automobiles all depend on foreign supply chains globally. A 10% dollar decline translates to roughly 3% extra consumer inflation. That inflation arrives during already painful post-pandemic cost of living increases everywhere. Social Security cost of living adjustments cannot keep pace with real purchasing power losses. Retirees on fixed incomes get squeezed harder with each passing quarterly CPI report. Young Americans trying to buy first homes face impossible mortgage payment math. Middle-class families watch their grocery bills climb while wages barely budge quarterly. This trillion-dollar Japanese story affects every kitchen table from Maine to California. So, what should ordinary Americans actually do about this unfolding financial earthquake today? Financial advisors emphasize portfolio diversification across hard assets, international equities, and short duration. Locking in fixed-rate mortgages before further yield increases could save thousands yearly. Paying down variable-rate credit card debt immediately shields families from rate shocks. Building emergency savings in high-yield accounts provides cushion against unexpected market volatility ahead. Avoiding long-duration bond funds during rising yield environments protects principal from devastating losses. Precious metals, energy stocks, and inflation-protected Treasury securities historically hedge currency weakness well. Real estate in growing Sunbelt cities continues showing resilience despite higher financing costs. Diversifying income streams beyond single employers creates stability during corporate layoff cycles. Understanding these macro forces empowers American families to navigate the storm far better. The politicians will not warn you, and corporate media will downplay the risks. Japan's trillion-dollar decision is the most important financial story nobody discussed this year. What happens in Tokyo over the next 12 months shapes American prosperity directly. Watch the monthly Treasury International Capital reports released by Washington every single month. Track Japanese 40-year bond yields, which telegraph where American rates move next. Monitor the yen-dollar exchange rate, an early warning system for capital flows. Follow Bank of Japan policy statements carefully as they signal capital repatriation timing. Pay close attention to gold, silver, and Bitcoin prices as confidence barometers. These data points tell you more than any cable news anchor ever will. Financial freedom starts with understanding where your government actually gets funding from globally. When that funding source walks away, everything about American life changes suddenly forever. Japan is walking away slowly, one bond sale at a time now. The only question left is whether Americans wake up before rates explode further. If this breakdown gave you real value, smash that subscribe button immediately today. Drop a comment below telling EconWire USA which country threatens America most next. Share this video with every family member worried about their financial future ahead. Turn on notifications so you never miss another hard-hitting financial truth drop. This is EconWire USA, signing off until the next critical economic story. I'm telling you right now, America just got hit very hard. The single most dangerous financial move of this entire decade just happened. 99% of Americans have absolutely no clue this even occurred. Japan, our so-called ally, holds $1,239 billion. That money represents U.S. government debt sitting inside Tokyo's financial vault today. That amount exceeds China, exceeds Britain, exceeds every other nation on Earth. In May 2025, Japan's finance minister said something absolutely unthinkable on television. Katsunobu Kato called those American bonds a card on the table. A card on the table aimed directly against the United States government. Since that moment, the 30-year Treasury yield has surged toward 5%. Mortgage rates in America have exploded past 7% for average homebuyers. Your 401k, your savings, your retirement account is quietly bleeding out today. Before going deeper, hit that subscribe button on EconWire USA right now. This channel breaks down the numbers Wall Street hopes you never see. Now let us get into the actual facts driving this financial earthquake. According to Treasury Department data released February 2026, numbers tell everything. Japan's total Treasury holdings hit $1.239 trillion. The United Kingdom ranks second, holding $897 billion. China sits third place with roughly $693 billion. Japan alone owns nearly double what China holds in American debt today. Why does this gap matter so much for every single American household? Because Japan has quietly financed American deficits for over 4 straight decades. Japanese banks, pension funds, and insurers funded our wars and stimulus checks. They absorbed trillions when nobody else wanted to buy American government paper. That long, loyal partnership is now cracking wide open in real time. The cracks started forming in early 2024 with a major Japanese bank. Norinchukin Bank, Japan's 5th largest lender, announced plans to unload billions quickly. The bank publicly committed to selling $63 billion in foreign bonds. Most of those bonds were American treasuries, bleeding losses on their balance. That was the first public warning shot fired from Tokyo toward Washington. But the real shockwave arrived in May 2025 from the highest levels. Finance Minister Katsunobu Kato appeared on Japanese television during trade negotiations. He said Treasury holdings exist, quote, as a card on the table. The Financial Times described this statement as a rare baring of teeth. The Associated Press confirmed Kato's exact words on the same public broadcast. No Japanese official had ever publicly threatened such action against America before. The statement followed Washington's announcement of 24% reciprocal tariffs on Japan. Trade tensions between these two economic giants exploded across diplomatic back channels. Bond markets reacted violently the moment Cato's remarks hit international news feeds globally. The 10-year Treasury yield jumped 6 basis points that very same morning. The 30-year yield climbed 9 basis points, pushing near 4.93. These numbers come from CNBC and Bloomberg reports, not social media speculation. But the Treasury yield spike was just the visible tip of disaster. Underneath Japan's banking system, 3 massive forces are pushing capital toward home. Force number 1, Japanese domestic bond yields have absolutely exploded higher recently. Japan's 40-year government bond yield hit a record all-time high January 2026. For decades, Japanese yields sat near zero, forcing investors abroad for returns. Now Japanese pension funds earn real yields without touching a single dollar. Force number 2 involves the weakening Japanese yen against America's strong dollar. Japanese investors hedge currency risk when buying American treasuries, adding substantial costs. Hedging costs now eat nearly every penny of yield on American debt. Force number 3 comes from Japan's massive government pension investment fund. That fund manages over $1.5 trillion for Japanese workers. Roughly $400 billion sits inside American government treasury securities currently. Tokyo wants that capital pulled home to defend the collapsing Japanese yen. That repatriation alone could dump $400 billion onto American markets. $400 billion equals roughly 20% of America's annual federal borrowing. 20% additional supply crashing into already weak demand spells serious disaster. Meanwhile, America's national debt clock just screamed past $36 trillion total. Washington needs buyers every week just to roll over maturing government debt. The Congressional Budget Office projects another $2 trillion deficit this year. Interest payments on existing federal debt now exceed $1 trillion annually. That amount exceeds the entire annual Pentagon defense budget by wide margins. Every basis point higher on Treasury yields costs taxpayers billions extra yearly. If Japan's selling pressure pushes yields up just 50 basis points further, American taxpayers would face roughly $180 billion more in interest. That is money not spent on schools, roads, Social Security, or Medicare. The squeeze flows directly into your kitchen table through very real channels. 30-year mortgage rates track 10-year Treasury yields almost perfectly every time. When foreign buyers retreat, those yields climb, and your mortgage payment explodes. Average home buyers in America already face rates above 7% right now. A $400,000 home costs nearly double compared to 2021. Auto loans, credit cards, student loans, business loans all climb in tandem. This is why Japan's trillion-dollar threat matters to every working-class American family. Wall Street analysts have already started pricing in this tectonic capital shift. Deutsche Bank analysts warn Europe holds $8 trillion in American bonds also. If Japan triggers the avalanche, Europe could follow, then other Asian nations. That domino chain could unleash a global reset of the American dollar. The dollar has already lost roughly 20% purchasing power since 2021. Gold prices have surged past $5,000 per ounce this year. Silver recently broke $100 per ounce for the first time. Central banks globally are stockpiling gold at record-breaking annual purchase rates recently. These signals scream that confidence in American government debt is quietly eroding. Meanwhile, Japanese Prime Minister Takaichi launched massive new fiscal stimulus spending packages. Bank of Japan has officially stepped back from absorbing domestic government bonds. Japanese investors face a brutal choice between yen bonds and dollar treasuries. For the first time in 40 long years, they are choosing yen. That single decision puts America's entire financing model under unprecedented severe strain. The Federal Reserve cannot easily fix what Tokyo's capital exodus is creating, and the story only gets more dangerous when you understand Washington's response.